Hello everyone, welcome to today's session. For today, we'll be looking at trading strategies, mastering trends, ranging trend, and a breakout trading strategy. All right, welcome to model 4 of our intermediate trading. If you've missed the previous session, do well to check from the playlist, watch the previous session, get yourself educated with these videos. Along your journey, if you have any question, don't hesitate to drop it as a comment, and I and my team will do well to respond to you. Thank you. Now, what we're going to be covering today, we'll talk about trend trading, range trading, and breakout trading. Breakout trading is very famous. As a trader, you want to follow the trend. You don't want to trade against the trend. The trend is your friend. Yes, awesome. But now a trend doesn't always continue. Trends always change. So breakout trend trading helps you trade when the trend has changed. Also, we look at, basically we have three types of trend. Okay, we have the horizontal trend, we have the horizontal trend, or we can call it the ranging trend, we have the uptrend, and we have the downtrend. Yes. Now, trend trading is a strategy that involves identifying and following the direction of the trend. We have uptrend, we have downtrend. In an uptrend scenario, we have a lower high, we have a low, we have a high, we have a higher low and a higher high, followed by a higher low and a higher high. When the market keeps on presenting this path, it shows that it's clearly in an uptrend. So characteristic features of an uptrend, you want to see consecutive higher highs and higher lows. When there is a change in that market structure, that indicates a possible change in trend. And then you watch it, observe it for a breakout, and then you take the new emerging trend after you've got your confirmation from the market structural shift. When I say structural shift, when the market changes, from example, from an uptrend to a downtrend, when the market stops giving us higher highs and start giving us lows and lower lows, that is a downtrend. Now look at it. From a high, we got a low, a lower low. Remember, in an uptrend, we expect to get a higher low and a higher high. Here we got a low, a lower high. This is a peak. The peak was low, not as high as this previous peak. Then what next? We got a lower low, lower than this previous. Then we got another lower high. These are characteristics of a downtrend. So a downtrend, we want to see lower highs and lower lows. So there you go on uptrend and downtrend. Characteristics of an uptrend, we have higher highs and higher lows. Downtrend, lower lows and lower highs. You can use a trend line tool to draw it. So whenever the market should tap into this trend line, you know you want to continue resuming the buying trend. The market, yes, when we have an uptrend, you want to look for buying opportunities, but you don't just buy at any point. Now, when you draw a trend line tool, it enables you get fine-tuned sweet zones to take your trading entry from, or we can call it optimum trading zones, all right, to get into this market at discounted price. All right, here now we have ourselves an uptrend, but let me just say we discover this market at this point. Are we going to just take a random buy here? No, of course we don't want to take a random buy here. You want the market to retrace, you want the market to cool off, you want the price to get cheaper for you to enter at a better zone, discounted price, and then take it up to the next premium or to the next high. All right, so this trend line tool helps you identify that. Amongst every other tool, the trend line tool is an effective tool for that. Now your trend line, this is our trend line tool. Remember, look at this. Whenever the market taps into this trend line, we want to resume the buying. Here, let's say the market came in, give us a higher high, a high, a higher low, a higher high. Okay, guys, established. We have an uptrend. You're still observing. You not just take any trade at any random points. Let it get back to our trend line. It comes back to the trend line we're observing. You can even go down to a lower time frame from here. Find yourself a bullish engulfing pattern. Or this is a very good entry. Take your trade. Take your trade. Take your entry. Your stop loss will be below the previous swing low, because market characteristics of an uptrend is higher highs and higher lows. When there is a change, is an indication that is a possible change in market direction. Now your stop loss will be below the zone, and your target will be at the previous most significant swing high, because for the fact that this is an uptrend, you want it to continue in an uptrend. So for the fact that it's an uptrend, you take profit to be at the zone, and then your stop loss will be below here. Now trading this way, what happens? The market kept on ranging, gave us another higher here. It gave us a lower high, but then what happened? We got ourselves still on a higher low. Okay, we are still up, we're still holding. Our stop loss is here, we're still watching. Some people could even take in more trades, but I don't advise that. Take one trade and let the market run for you. Still running, still ranging, still multiple taps, multiple taps, multiple buying position if you missed any of them. Here we had ourselves a doji candle plus a bullish engulfing candle. This here we still got another bullish engulfing candle, multiple confluence, just if you did not take your trade from the zone. So looking at here, multiple consolidation from a lower time frame perspective, and eventually what do we get? The prevailing trend won the market. Obviously, what do we have here? A push to the upside, taking us out on take profit. Good profit was made, and then that's how we trade. Now the market came back to tap into this our trend line zone. What happened? We got a massive bullish engulfing candle at this point. You can sometimes this move could mean a lot depending on your time frame. So when you notice the market has tapped into your trend, you could go to a lower time frame to find an engulfing candle or an entry candle confirmation pattern or an entry candle confirmation pattern, and then you take your trade, your stop loss below the most significant swing low, and your target the most recent swing high. This is our target here. 1, 2, you're doing in and out, you've made your profit. Now on the downtrend scenario, what do we have? Remember, we want to see lower highs and lower low. What do we have here? We have a high, we have a lower high, we have a low, we have a lower low, we have a lower high, a lower low, a lower high. These are the characteristic feature of a downtrend. Now, even though you have to draw your trend line tool, whenever the market should tap around the trend line tool, then you want to take yourself an entry confirmation. You want to find an entry confirmation to enter in alignment to the main trend. Guys, in trading, the trend is your friend. You want to follow the trend, but you don't just enter at any point. You don't just buy high, but you buy low to take your profit high. You buy at discounted prices and you sell at a high point so you can get it down. Do you understand? So if you're drawing the trend line to another zone, whenever the market taps into the trend line, you find yourself an entry to keep on selling the market to the most recent swing low. That is where you take your take profit and your stop loss from. I hope you're learning. I hope you're taking a lot of value from this analysis, from this educational content. Awesome. For everything I have covered, if you have any question, please don't hesitate to ask. I am here to serve you the knowledge of Forex trading. Currently, we are at the intermediate trading level. So anything on the intermediate that I've covered and you have a question, please do well to ask that question. Now, moving forward, we're going to look at the moving average in trend following, okay? The moving average, as we talked about in our previous section, we have the SMA and the EMA. SMA, simple moving average, and the EMA is the exponential moving average, all right? You can use it to identify the trend. When the chart is above, when the candle price action is above the moving average, that is to tell you that this is an uptrend. But when it is below the moving average, that is to tell you this is in a downtrend. Now, the moving average that we use for this is from the 50 moving average all the way. We have the 50, we have the 100, we have the 200 moving average. The 200 moving average, we can call it a dynamic support and resistance level. Whenever the market is above that zone, you know that, okay, this market is in an uptrend. When it's below that zone, it's on a downtrend. Same thing with the 100, same thing with the 50. There are so many trading strategies you can use you can take advantage of in using this. Now, what do we have here? The market was around the moving average. We could call this a ranging trend, all right? There was no clear direction. It broke out to the upside, and what did we see? It came back down in. If you look at the previous trend, it obviously was in a downtrend, all right? We got ourselves from a very strong bearish engulfing candle. This would be just a classical liquidity sweep, but let's not talk into the advanced. Let's keep everything on the intermediate level. With this alone, you can get to make a lot of money from the market. What do we have here? The market broke, all right? It broke our moving average to the downside, but you don't just blindly take a trade. You want to get yourself a confirmation. You wait after the break. This, you can call it broke, and then this was a retest, but not, I won't call this a proper retest, but you could call it a retest. When the market came around, some could enter that trade from this zone. That stop loss, sweet stop loss here, and then your target from the chart, you look at the previous significant low to put your take profit at that zone. Even though you missed out on this part, here's another area. The market came in to the moving average, but it did not break it to the upside. This was just a weak penetrating. This is not a confirmed break. It came in to tap into this our moving average, and then we find ourselves a trade to trade off of here. You go down to the lower time frame, you find yourself some entry confirmation, and then you take your trade, your stop loss at the most significant structure. Here in this case, since it's a downtrend, at the most significant high, and then your target is at the most significant low. Target 1 could be this level where you see. Target 2, you can look at the previous chart history to find the target 2, and that is how you trade. Trading this alone has a high probability win rate and puts you at more profit than a loss. Here, what do we have here? The market came back. It came back to this moving average. Now, what do we see here? We have we have a cross. Now we talked about, we have the dead cross and we have the golden cross. Golden cross is giving us a bullish confirmation pattern. We got this our crossover. Now we are observing the dangerous binding trade. If now here, what do we have? The crossover we're still observing, and the crossover, the market began to trend to the upside. But let's say you missed out on this trade, you did not go to the lower time frame to find yourself an entry confirmation. When I say the lower time frame, let me say, for example, we're on the 4-hour time frame. You can take it 2 time frame below. Let's say from the 4-hour, you go to the 30 minutes time frame, or even the 15 minutes time frame to get yourself an entry confirmation. If you're looking at this on the 1-hour time frame, you can go all the way to the 15 minutes time frame to get yourself an entry confirmation. If you're looking at this on the daily time frame, you can go to the 1-hour time frame to get yourself an entry confirmation. All right. And so, but don't look at the 5 minutes. The 5 minutes has a lot of noise. Only if you want to scalp the market. All right. Good. Now the market broke, giving us a change of character. Remember, lower lows. See, we had lower highs, all right, and we had lower lows. Then all of a sudden, the market broke at the zone. It took out, there was a change in market structure here, right? A change in market structure, which was here, a break and a retest. Now it gave us a break and a retest. At the retest, what do we see? We see ourselves a bullish engulfing candle. You simply enter, you take your trade. Your stop loss could just be here because this was also a low, all right? Your stop loss will be here and your targets 1 all the way. Since your entry is here, target 1 will be this one, and then you look at the chart to find your next target 2, and that's how you make your trade. Following this alone puts you at high probability winning trades. All right. Now we have something we call before we get onto that, this is another example of how we execute our trend line. All right, trend lines, how we execute our trend trading with the moving average. Now you enter the trade, you enter trades in direction of the trend. Remember, the trend is your friend. You now use the moving average and your trend line tool to get confirmation on your entries and your exit. Yes, the market is trending downward, but don't just enter at any point. You wait for it to come into tap into our moving average, find ourselves tapping in. We got ourselves some bearish looking sweet confirmation. You could enter from this level, but you seem too quick. You enter from this level, you take your trade here. This is very good entry. You took your trade here. This is a very tight stop loss, guys. The best stop loss I love is just above the zone. All right, just here, stop loss, and you set your targets from previous history. And what happened? Eventually the target was hit, and this was a very sweet trade of about what do we have here? This ratio about 1 is to risk and 4 is to reward. That is an awesome risk to reward ratio in trading. Now the ranging trade involves buying at support and selling at resistance. It is horizontal, all right. It's ranging, just going up and down. As a true trend follower, I don't like trading the ranging trend. It's not advisable to trade the ranging trend. It's so choppy. All right, you take your buy here, you take your sell here, you take your buy here, you exit, you sell. This cannot be sustainable because eventually that ranging trend, that horizontal trend will eventually break. All right, so that is why it's best to just trade a normal range, a normal trend. If it's an uptrend, you have yourself a clear entry, you enter. If it's a downtrend, you have yourself a clear entry, you enter. But that's just based on me. But if you want to trade the ranging trend, here's how it works. When it comes to support, you find yourself an extra confirmation here. We got some very good bullish confirmation. You take your trade, your stop loss to be below the support level, and then your target to be at resistance level. And that is how you do it. You can keep on recycling and filtering this and making yourself profit all the way. It's way more beautiful. You could follow the prevailing trend. Let's say this market could have been on a downtrend. You do the same thing. You take yourself from here, your entry, your stop loss is just here, and your target we are at the support level. What happens? Eventually, target was achieved. All right, so that's just that on ranging trend. Ranging trend, you buy at support and you enter and you exit at resistance, or you sell at resistance and you exit the trade at support. That's just it on ranging trend. Now, how do we identify ranging trend? Look at this from your chart. You see it is as though the market is consolidating. We can call it a consolidation, just ranging up and down, no clear bias, no higher highs, no higher lows, just ranging choppy. That is how it is. And this is a very good example of a ranging trend. Now, this is, as I've said, very good example of a ranging trend. Now, when we talk about breakout strategy, all right, breakout trading involves entering trades when the price breaks out of a consolidation pattern. When it is done with its consolidation, eventually it breaks out. Now, when it breaks out, you want to enter. All right. Obviously, a new trend has been created or the prevailing trend has won. But at the point of consolidation, in most cases, sometimes the market changes direction. But whatever the case might be, at the breakout, you find yourself an entry and you trade with what you see in the market, not what you're hoping to see, but specifically what you see from their own analysis. Now, what do we have here? Look at this type of triangle pattern, guys. We had ourselves a triangle pattern and a symmetric triangle pattern. We had ourselves a triangle pattern. Not just that, the market was ranging. Because of this triangle pattern, you can just enter the trade at the break. Not just a wick, okay, but you want a full-bodied candle like this. You take your trade and voila, you shoot for target. This is another way to enter. You normally, if this market did not give us a triangle pattern before the break, then I will tell you to just, after the ranging, if it's a typical horizontal ranging type of trend, you wait for a break and then a retest, just as we had in our moving average scenario. We waited for what? A break and a retest. This is it. All right. This is it. We got ourselves a break. All right. And this was our retest. And then we entered. But now when we see a triangle pattern, this gives us more multiple confirmation, telling us, okay, what do we see from this? At the point of that break, the direction the market broke out of, that is the direction you want to enter. Not just with a candle wick, but with a full-bodied candle. And then you enter, you take your trade, and you're sliding in profit. All right. So then, how, again, as I said, identifying breakouts. Okay. You look for consolidation patterns. When I say breakout, it was obviously being held by something. It was obviously consolidating. Then we got ourselves what? A breakout. After that breakout, what do? You enter at sweet zones. Okay. This is it. The market was previously in a downtrend. All right. In a downtrend, creating lower lows and lower highs. Then it began to range at the zone consolidation. And then what do we have? We got ourselves a breakout, and then it came back, giving us a very good bullish engulfing candle. This is all I need. I take my trade. My stop loss could just be below this candle. Yeah, nice and good stop loss. This is on a 15 minutes time frame, USD JPY. All right, my stop loss could just be here, and my entry is here. My target 1 will be here, and then target 2, I'll look at previous history and write this market. All right. In reversal breakouts, okay, we tend to feel that the initial trend was wrong and began to push the price in the opposite direction. In the whole highlight is this: sometimes there could be a retracement on a higher time frame. That retracement on a lower time frame might look like a trend. Now, after that trend, before it changes and correlates with a higher time frame, sometimes we see ourselves a consolidation. After that consolidation, the market resumes with the higher time frame trend. All right, because the trend, as we see, we have an uptrend, right? Higher highs, we have higher highs and higher lows. All right, for the market to continue, after a higher high is created, it will retrace, giving us a lower high. Then what next? A higher high. So that little retracement on a higher time frame is a little retracement, but looking at it on a lower time frame, it can mean a lot. All right, so that is why the best way to trade when you're making multiple time frame analysis, identify the main trend on the higher time frame. Now come down to the lower time frame, wait for the market to correlate in alignment with that higher time frame, and then you take your entry. All right, this gives you more props, more wins. That gives you more high win. This gives you more winning rate, and also give you more high risk to reward ratio. All right, trading with the main trend, trading with the higher time trend. All right, so enter trade when the price breakout. You can use a volume or momentum indicator as confirmation. Some of us here, we can add volume indicators in our chart. When the volume is massive, telling you a lot of people are entering. Even notice something, when the market is consolidation, volume is just very less. Also, trading sessions, if that session, those two sections are very active, consolidation tends to break out. But when one of them is closed, that is when you can see it, sometimes consolidation. But let me say you're trading GBP USD, and during the Asian session, when the both of them are closed, the market tends to consolidate. It tends to be choppy. But when they are opened, you get to see yourself, the market is no longer like when the both of them are open, it tends to break out of any consolidation that it had. All right, so when you want to trade, as simple as I said, to recap, looking at an uptrend, you want to buy, but you don't just buy at any random point. You want to buy at support and take your profits at resistance. Or you want to buy when you've joined your trend line. When the market taps into that trend line, you look for entry confirmation. You take your entry and your stop loss will be below significant low, and then your target to be at the next your target to be at the other swing high. That is how you make a trade. It makes you very, very profitable. Now, this is the conclusion on this. Now, I want to show you from my own charts how it looks like. All right. So let's look at this. So this is an example of area US dollars. What do we have here? We have ourselves an example of a clear uptrend. We can use our trend line tool, right? This is our trend line tool, right? Good, awesome. What do we have here? The market came in, right? The market came in, tap into the zone because of a bullish entry confirmation. Looking at this, you take your trade, your stop loss will be just at these zones, right? And then your target 1 is here, target 2 is all the way to the zone. Let me show you guys a very good example of how this can be done. We see we're in an uptrend, all right? You want to take your trade in alignment with the trend. Your stop loss, this is a very good stop loss. Okay, this is on a 4 hours time frame. Okay, this is on a 4 hours time frame, so you look at it on a lower time frame because this stop loss is going to be obviously massive, right? Good. Take your entry. This is a very good zone. How many pips are we looking at here? Okay, this is not so bad. This is about less than 40 pips, right? Not more than 40 pips. Awesome. So this is a good zone. So 40 pips is our risk here. Now, where is our target? We're not just taking target because of what we feel like, but we're taking target based on what the market told us, right? So this is TP1. You can call this TP1. TP1 has already given you back what you were willing to risk, but that is not a sweet one. This is another target. This is a very good target here, right? The most recent swing high. You can just keep it here at the peak or here, anyone you choose. Let's just see, this is what we use. So what is our risk to reward ratio here? We are risking 1 to gain 4. We are risking 40 pips to gain what, guys? We are risking 40 pips to get 160 pips, about 160 pips. So that is an awesome one. From the calculation here, all right? So that is an awesome one, all right? That is an awesome one. So this is what makes you profitable, trading with the main trend, all right? The market kept on playing out until eventually we got ourselves tagged in to profit. Now, still on that, moving forward, what is the next trade? The market came back again to tap into that zone. As it tapped into that zone, what do you want to do as true trend followers? We got ourselves a bullish engulfing candle, and then what next? You take your trade. After the close of the bullish engulfing candle, you take a trade, not before the close. All right. Now, this is our take profits 1. Take profits 1 or all the way to the zone as you wish. You take profits 1. Even your take profits 1 is giving you about a 1 is to risk and about 2.7 is to reward. This is an awesome win rate. This is an awesome trade. Puts you in more profits than in losses. Taking this alone, you've gotten yourself some good entries. Now, what do we have? Remember, we said a trend doesn't last forever. Eventually, this trend, what do we get? A break and a retest. This is a breakout. The market broke the trend to the downside. Remember, not just because of a tepid trend you want to enter. You really want to enter when that trend has given us a confirmation. Like when it taps the trend line, don't just blindly enter. Wait for an entry confirmation. When you get yourself an entry confirmation, then you take a trade. It tapped into the zone. We did not get ourselves any entry confirmation. It broke it to the downside. All right, we're not just taking any trade, right? We just have to wait for confirmation. It broke it to the downside, it kept on ranging, then it came back. This is what we call a classical break and retest strategy. All right, this was the zone of the break and retest. At this zone, you could even go down to the lower time frame, find yourself some entry confirmation, and then you take your trade. Sweet trend line trading, here, guys. Typical sweet trend line trading. You take a short position because yes, the trend has changed. We're no longer seeing higher highs, but look at it. Yes, we were seeing higher highs, right? Higher highs, higher low. This was not a very good clean higher high, okay, but we were still observing. Then the market came into tapping our trend line. The trend line still has not been broken. We're still officially in an uptrend. Then what do we have? We got ourselves another higher high. Then we got a lower high. Then we got a very significant low. This low took out this previous level. This you can even call it demand level, okay? This was our previous low, right? This is the demand level. So let's just call it demand or support level, whatever. All right. So this is the support level, right? So the market came in, eventually broke it. It broke it, right? After it broke it, you're waiting for a break and a retest to enter. It broke it. Remember what we said about support and resistance. A level can be a support level. When it is broken, it begins to act at resistance level and vice versa. A level can be its resistance level. When it is broken, it begins to act as a support level. Now, the market broke it. Okay, you're waiting for a retest. It broke it, it came back to it, all right? But you don't just take trade blindly. You're observing it. You go down, you're observing it. You can now go to the lower time frame. This was June, all right? What do we have here? This is a very good bearish engulfing candle. You take yourself a sell trade. Your stop loss, this could just be a very good stop loss. I'll just add the trend line tool. That is our stop loss. And then our target, this is obviously our target one. Even target one has given us back what we're willing to risk. But then that is just for target one. When target one is achieved, what we love to do is move our stop loss to break even. All right. And we can, if you want to take out some partial profit. Now, target one is achieved. What is the next significant low? This is it. This was our level. The next significant low is here. This level, right? This levels, these zones. So let's target it and see what happens. Okay, good. Now, this is how many risks? We're risking one to get about 1.6, right? So what do we have here? Okay. The market tapped in very clearly, very nice, as we can see. Even though you went all the way lower to this low, to the week here, eventually you got tagged in. So that's how you trade, all right? That's how you trade. Now, what happened? We took ourselves a very good profit. And what did we see here? The market began to range. The market began to range. This was a ranging trend, just going up and down, up and down. But let me give you a very good drawing, all right? This is it. The market began to range. The market began to range. It came in here, began to range. Some can find themselves range traders, all right? Find themselves some sells, take the sell here, take the profit, come back again, sell, take the profit, come back again here, sell. Remember, you did not eventually hit target. So that's why I don't like trading inside a range. I want to wait for a breakout. What do we have here? The market broke out. Broke out where? Where, guys? To the where? To the upside. Now, the market broke out to the upside, obviously. You don't just enter brandly. You could sometimes use a Fibonacci retracement tool to find yourself a good entry, or you could use your moving average tool. Let's say we are using the moving average tool to find ourselves an entry here. Let's put it in the moving average. EMA, exponential moving average. All right, let's use an indicator to see what happens here, because here we got ourselves a break. All right, a break. You want to enter after the break, then this is not so good of a confirmation. You don't just take entry at any point. This is a very good looking entry though. Some could enter here with this bullish engulfing candle, but then where's your stop loss? The stop loss is all the way here. This seems too big. All right, what you tend to do is just go down to the lower time frame, or simply put in a moving average tool. All right, moving average. Let's use the exponential moving average. You can just simply search EMA, all right? Exponential moving average. This is it. All right, so what do we have here on the EMA? The EMA tool is inserted. We are currently at 9 period, so we want to change it to 50 moving average, all right? So we go to the setting. This is how you do it on TradingView, all right? You go to your setting. Let's use 50. Awesome. Now, what do we have here? Remember, we say when the market is above the moving average, you want to look for a buy entry. Here, the market broke our EMA, all right? It broke our EMA and then came back for a retest. At this point already, you find yourself an entry. Wow, that's nice. Indicators can be good, but indicators can be lagging. But this indicator gave us a very good trade. The stop loss sweet at support level, and then your target. Our target to be where? At here. This is our target here. A previous significant high. All right, the next this target one, target two is all the way to this next high. All right, these trades alone give you sweet entries. So this is how you trade. This is how you trade and be profitable. Just have to follow the rules of what works. Have to follow profitable trading. All right, profitable trading, follow the rule of what works. With these examples alone, as we back tested, we've seen ourselves some good trade. So this is something I advise you to do. Always back test and find good trades. Backtest and find confidence in your own trading. All right, backtest and find confidence in your own trading, and do what? Stick to it with proper risk to reward ratio. Stick to it with proper risk. Risk only a certain percent of your account per trade, and this is what is going to make you more profitable in the long run. All right, so you're still looking at this. What do we have here? We had ranging rate. If you're truly following the moving average, the moving average tells you to exit only when the market comes in and cross to the downside. Following just the moving average at this point, The only point where you enter this trade is when the market crosses. That means you have to be observing it. Or if you don't want to observe it, just use the most recent high as we did here. All right. So now here what we have, the market came in to tap. This is an example of a losing trade if at all we took this trade. This market here came in to tap, giving us a very good bullish engulfing candle. That was not the best bullish engulfing candle, but it's what it is. Came in here, your stop loss. These are our stop loss and our target. Okay, even looking at this, for the fact that it's on a 4-hour time frame, this is still a good trade. But then what happened? Eventually, the market hits our stop loss. All right, our stop loss here was taken. That is how it is in the market. You win some and you lose some. That is why you always have to trade with proper risk management. Imagine for all this trade we've taken here from this simulation. All right, from this trade analysis and example, how many trades have we taken off from here? We have 1, 2, 3, 4. 4 trades that were in a win, right? And we made a lot in a win. 4 trades and we lost only 1. And then when you're risking only 1%, or for example 10% if it's a live account, 10% not a funded account, okay, just 10% of your account if it's a funded account, not like prop firm type of account, but 10% of your account, risking 10% of your account. This trade, how much did you get? You got 40% out of it. Here, what did you get? You get about 2.7, like 27% out of it. Here, what did you get? You got how much? 26% out of it. That is awesome. Here, what did you get? You got like 3.32% out of it. That's awesome. Then here, what did you lose? You lose just 10%. So this type of way of trading with risk management and following what works, being a good trend follower puts you in profit. So that's just that on the recap. I believe this video has been very informative to you. Now, still on today, what we have here, I believe this video has been very informative to you. Still on moving forward, we're still okay. The markets, we're in an uptrend. Don't forget the trend we are in. Remember what I said. When you see yourself in an uptrend, you want to only be what? Buying, looking for an opportunity to buy. That is why we lost this trade, because we took a trade against the main trend. We have ourselves an uptrend, so you really want to trade in alignment with the main trend. Please let this sink in well. Don't forget this, all right? This is for your own learning. Always go back and review the markets and back test it to get proper understanding and confidence. We are in an uptrend. Remember the characteristic of an uptrend. Remember, after this ranging trend, we broke out to the upside. We got ourselves a high. We got ourselves a low. What are we looking for? Continuation to the upside. Now, this market is telling us to sell, but we don't want to just blindly take a sell, because we really want to take a trade in alignment with the main trend. So what are we looking at here, guys? The market now is above the moving average. We now look for an entry above the moving average. If you want to just use the moving average and the trend line tool and the trend to take a trend. Here, what do we have? The market broke. All right. Now you're waiting for your retest. Remember the break and the retest we're trading. The market came in, retested it at the zones. We can even go to the lower time frame and find yourself an entry confirmation, because I tell you, definitely you'll find yourself an entry confirmation here. Or you could even wait to this point. What do we get? We got ourselves a very good bullish engulfing candle. After this bearish engulfing candle was registered, that is. Then what do we see here? A long trade in alignment with what? The main trend. You really want to trade in alignment with the trend. Remember, the trend is your friend. This is our target 1. Okay, this is our target 1. This is not a very good target. So what do? We look at, since you're following the moving average, you only take your trade after the market has crossed. All right. Or if you don't want to just keep your eyes fixated on the price, you go back to previous history to find sweet zones to take your trade from. This is what we do. This is how I trade. I'm just trying to show you how it's done. All right. So this is our previous history. Okay. So where was this? This is it. All right. We're targeting the zones. Okay. This is a very good resistance level. Yeah. Resistance or supply level. All right, so when the market came into that zone, you've already taken your profits. Now you're still observing the market. This is how we set our trade. This is how we take our profits. All right, this is how you do it. You must not wait for the moving average to cross. Now look, if you were waiting, as I was doing when I was still a beginner trader, that was some 2-3 years ago, I would be waiting for this market to come in and cross again before I take out my trade. But doing this, I tend to lose a lot of profit that I have made, because now look, we got ourselves some good profit. Look at all the way we still came back to come and start waiting for it to give us a trade is not good. So moving average is a nice tool, but always add it up with other things to get yourself a good trade. All right. So here, what do we have? Even though you're not there, even though you're offline, you can take a trade, go out with your own daily activities, let that trade run for you. But if you're just using only the moving average, you're not looking at previous price significant levels to take your target off of. You just be there observing the market every time, waiting for a cross for you to close your trade. Because when I was learning trading, this is how they told us to do it. That is how I learned it. You only close your trade when the price crosses. All right. Let me say you were buying in an uptrend. When that trend changes on a moving average perspective, that is when you take your trade. But that is not sustainable because that will keep you glued to the screen. But that is not a good way to trade. So when you look at previous histories and take your target off of previous histories, it makes you trade effortlessly. You take a trade, just go and chill on the beach or whatever you want to do and let the market run for you. All right. So that's just that. So now what do we have here? That's just that. We've made ourselves some good entries, and that is how you trade. That is how you trade. Still on the intermediate level, I've showed you without even being an advanced trader. Yet I call this intermediate. To some, this can be so advanced. There is so much to learn. But with this alone, you're awesomely profitable. How many trades did we take off of this? We took 1, 2, 3, 4, 5, 6. We took 6 trades. Out of these 6, only 1 was a loss. And do you know how much we gained out of this trade? When we are reaching only 10%, on average, on the minimum, we're getting 2 point something, like 20 something percent. So that is an awesome trade. So I believe you've taken out some value from this trade. I believe you learned something very good. Don't forget, if you have any questions to ask, don't hesitate to ask. See you in our next session. Thank you so much. Thank you so much for enjoying the session with me. Any question, don't hesitate to ask.